Hi everyone, my name is Miranda Tyler, and today we're going to be discussing how we can evaluate an investment project using the NPV, or the net present value method. Specifically, we will be exploring the case 95 Bunyan Lumber LLC, which would be from Chapter 7 of our textbook, and our textbook is Corporate Finance, Core Principles and Applications by Ross, Westerfield, Jaffe, and Jordan. So an overview of the case. Bunyan Lumber is a company that is considering an investment to expand its own operations. So basically we need to figure out and determine whether it's kind of like a worthwhile venture, if it makes sense to do. So basically in order to do so, we'll need to perform a detailed financial analysis using NPV, along with a sensitivity analysis, break-even analysis, and some other real options. All of these tools are going to help us evaluate both potential returns and risks that are associated with the investment itself. So moving on to the first steps. Step 1 would be incremental cash values. Let's start by calculating the incremental cash values, which are the additional cash flows expected from the investment. These cash flows are broken down into several components. So the first component is the initial investment. The initial investment is the company will need to make an initial outlay. So basically the cost of new equipment, which is going to be $85 million, the cost of land, which is going to be $7 million, and the initial net working capital, which is going to be $2.9 million. The total initial investment would be about $94.9 million. So on to the second step would be operating cash flows, so OCF. The project is basically going to generate cash inflows each year, which are operating cash flows. So in year 1, we're expected to have an operating cash flow of $26.818 billion. Year 2 is going to be $31.67 million. Year 3, $31.24 million. Year 4, $24.5 million. Year 5, negative $1.74 million, which is a loss. And year 6 is going to be negative $4.65 million, which is an even further loss. So moving on to the third step, which is terminal year cash flow. In addition to operating cash flows, there's going to be terminal year expenses. So specifically in this case, in year 5, Bunyan Lumber would incur a land reclamation expense of $2.8 million. So moving on to the second step of NPV. So that's going to be the calculation. So now that we have the cash flows, we need to essentially calculate the net present value, or the NPV, of the cash flows. NPV is basically going to tell us whether the present value of the project's future cash flows exceeds the initial investment or not. So basically NPV equals OCF times 1 plus WACC times T minus the initial investment. So OCF is the operating cash flow each year, WACC is weighted average cost of capital, and T is the year number. So by using this formula, we basically discount each future cash flow to its present value and subtract the initial investment. If the resulting NPV is positive, the project is probably profitable and should be considered. If it is negative, the project should not be considered and should be rejected. So the third step would be a sensitivity analysis. This step allows us to evaluate how changes in the future and changes in key assumptions such as sales volume, variable cost, or the discount rate might impact a project's viability. For the case of Bunyan Lumber, the main factors to analyze would be sales volume, variable cost, and discount rate. By varying these factors, we can kind of understand the potential for risk and returns and identify which factors have the greatest impact on the decision to proceed with the project. Moving on to the break-even analysis. In addition to NPV and a sensitivity analysis, we would also perform a break-even analysis to determine the minimum sales volume at which the project neither make a profit nor a loss. So this critical step is because we basically are identifying the threshold level of performance required for the project to be valuable and worthwhile. By calculating the break-even point, Bunyan Lumber can understand how much risk is taking on the terms of market demand and sales performance. If sales fall below the break-even point, the project could fail to cover its costs, leading to losses in the long term. So the last step would be real options. So real options are embedded in the project. Real options provide flexibility in decision making and can add additional value to the project. For example, expansion options. If the project is successful, Bunyan Lumber may have the option to expand its operations and get larger, which would generate even more cash flow. They also have the abandonment option. So if the project performs poorly, Bunyan Lumber can abandon the project entirely to minimize their losses. By incorporating these real options, we account for future strategic decisions that could either enhance the value of a project or mitigate potential losses. This kind of just allows for flexibility, and that's just a valuable aspect for investments. So basically, to kind of wrap things up, Bunyan Lumber can evaluate investments using a couple of following steps. So initially, they're going to start with an NPV calculation. If the NPV is positive, the project is considered. If it is negative, it should not be considered. Sensitivity analysis will be next. This helps to identify the impact of key variables within the project's success and evaluate potential risks. The third step would be break-even analysis. This shows the minimum sales volume needed for the project to break even, providing a clear performance benchmark. And then number 4 would be those real options. So these are going to be the flexible options that offer flexibility in the future, the potential for adding value or reducing risk, whether that be taking on more or taking less. So basically, by using all of these tools, Bunyan Lumber can make a more informed, data-driven decision on whether to move forward with the investment or abandon it entirely. So overall, I think that we've covered pretty much everything, but to just kind of go over a review. So in the first step, we talked about incremental cash flows. So we discussed initial investments, operating cash flows, and terminal year cash flows, and how all of those kind of coincide with one another. Then we moved on to the NPV, or the net present value. We talked about the formula for that, which is NPV, which is OCF times 1 plus WACC times T minus the initial investment. So with this, positive would be a project that is profitable, negative, it should be rejected. So with sensitivity analysis, we discussed sales volume, variable costs, and discount rate. With the break-even analysis, we basically just figured out the importance of it. It gives you the ability to identify the threshold level of a performance project, and just kind of see whether it's worthwhile or not. The last thing we talked about were the real options. In my opinion, I think these are one of the most important steps, because really it gives you the option on whether you want to expand or minimize or abandon entirely. So with the expansion option, we discussed how if the project is successful, they may have the ability to expand their operation, get larger, and gain further revenue and further cash flows, or they have the option to abandon it. So the project, if it performs poorly, they do not have to continue with the project. They can abandon the project early in order to minimize their losses. So I think by incorporating those real options, it gives you more of an understanding on whether a project is going to help to enhance the operation or if it's going to contribute to losses. So it just gives you the ultimate amount of flexibility, essentially. So just kind of to conclude everything here, the steps that Bunyan Lumber can use to evaluate their investment would be first, NPV calculation. NPV being if it's positive, the project is viable. If it's negative, it should be rejected. Sensitivity analysis, which again helps to identify the impact of key variables on the project success and evaluate potential risks. Break-even analysis, this shows the minimum sales volume needed for the project to break even. And real options, these are those expansion or abandonment options, which are the flexibility options for the future, just kind of to give us an understanding on whether a project is going to add to future cash flows and potential value, or if it's going to be a situation where we need to just reduce risk. So overall, I hope that this gave a clear understanding of how we can evaluate capital budgeting, specifically with projects using NPV and other important financial tools. I think that is going to sum it up, but once again, this covers Chapter 7, the Bunyan Lumber case.